Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the show where we're going to put our property experts to task answering your property related questions. And joining me to do that today is Bobbie Jethwa, CEO of UK Property Agents. Welcome, Bobbie.
Hi.
And Zee Razaq, CEO of Surtax St Albans, property industry tax experts. Welcome to you, Zee.
Hi, Stephen.
Good to have you both back. And we'll get straight on with the questioning. And question number one to Bobbie. I'm looking for a long-term property investment either in the UK or abroad. I wonder where I might get appropriate advice. Would a real estate search agent be a suitable party?
Possibly, yeah. I mean, it all depends on if they're looking at going abroad, then they need to do their due diligence on the real estate agent and what sort of advice they've given previously, what portfolio they have, the people that they've dealt with, and obviously closer to home, then it's another story where it's a lot easier for them to get that kind of advice. Maybe go and look around a few other agencies, get their information.
I think one of the things about that I've come across in the past is that there's always a sort of almost a discussion about whether if you're buying abroad, whether to use a UK agent that specialises in that country, or whether actually you're better off to go to that country and use an agent over there. I mean, obviously they've got on the ground information,
yes,
but I guess it becomes a matter of trust, doesn't it?
Yeah, absolutely. And I think basically if you've done your due diligence on that company that is actually in the country that you want to live in or to invest in, then it's a lot easier and it's going to cost a lot less than working with an agency that's based over here who's now selling or doing an investment overseas, which because their costs will be obviously involved.
Yes. I mean, usually a UK agent will have good contacts abroad, won't they?
They'll
have associate companies and things.
They should do, yeah. And generally they would. But I think if you're going, depends on which part of the world you want to go to. I mean, if it's Europe, then it's a lot more easier. But if it's going a bit further afield, then I think you're better off talking to the people on the ground there and getting an idea on the governments and their legal status and stuff like this. So definitely worth, sort of going out there, doing your own investigations. And then if an agent over here is dealing with properties over there, then you've got an insight yourself also to sort of proceed with something.
Yeah.
And know.
I suppose in one way, if you do use an agent abroad, the internet's made the world a very small place, hasn't it? So absolutely, you can actually check them out.
You can just go online now and just Google search or whichever search engine you want to use and see from there what company is reputable that have actually done these kind of transactions previously, and get some reviews. Check out the reviews on what they've done. And then see, obviously, with the returns, if it's an investment, see what the returns are like, and how secure your investment is, and how secure the country that you're planning to invest in is, also with their political maybe views or whatever.
But actually, the rules are just the same, aren't they? You've got to do the same checklist to make sure your investment works there as well.
Yes.
I mean, I can remember years and years ago working in Spain, and people used to say, the tourists and the purchasers, they leave their brains at Malaga airport and just get carried away with the sunshine and the image of the life they're hoping to lead.
Exactly. Yeah. So I mean that's basically the gist of it. It's you've got to do your due diligence on which way you want to go about trying to acquire the investment.
Right. So on balance, we're going for the overseas agent, really.
Yeah, I would say go for the overseas agent. Go to the country. Do your due diligence there, and then weigh up the options between the two, and then maybe come to an agent maybe in the UK that can also give you the advice. So look at both angles, and then weigh up your opportunity, which way you want to go.
Okay, Bobbie, thank you very much for that. Zee, we're going to move on to your question. Now you're going to need your crystal ball for this one. Do the panel have any advice for future investments in the rental market? And do they have a view on the future of the market overall? Now, it's an interesting two-part question, that, Zee, because the government do seem to be discouraging the smaller investor, and they sort of seem to want to term them as accidental landlords and things. I don't like that kind of terminology, because I think it's a bit disrespectful to minimise the value of a person's investments. You know, to some people, one investment is a huge step. If you have 10, of course, it's even bigger. But, you know, I don't think we should demonise the smaller investor, really. I think they've done a lot to help the housing market. Do you get that feeling with the government trying to discourage?
Answering the two parts of the question, I think the first part, financing, is something you've got to be factoring in when you're thinking ahead, because it's becoming quite a big beast at the moment, isn't it, with the fluctuation and what you're doing. If you're doing a buy-to-let, what kind of mortgages you're going to be getting, what kind of interest rate, very important. And structuring your business if you're doing a buy-to-let. I think those are two things when you're thinking ahead. From a government perspective, which is, I think, without becoming political and getting a little grief from everybody, I think one of the biggest issues is their tax strategy, because this is disincentivizing buy-to-let. And you're absolutely right, in my experience and what I see, and I'm sure Bobbie will have some views on this as well, the government don't really want that accidental landlord, because all of the policies they're doing is more and more compliance. And this is discouraging because it cuts down your margin unless you've got economies of scale. And I guess this is what's led to some big institutions, which I won't mention at the moment, investing and buying up a lot of buy-to-let properties. And I think this is the big issue. So yes, I think the government strategy is not the right strategy, because we're based on innovation, and it's not going the right way for a small investor, especially a less informed small investor.
Yes. Yes, interesting. And how do you see the market for the next 2-3 years?
This is, as you rightly said about the crystal ball, with the legislation changing, you need to be very professionally, like a more professional investor, in the sense having a structure that's going to actually meet your requirements. And that's what's going to be the big driver, because it is going to be a tough 2 or 3 years, especially for buy-to-lets, because the margins are going to get squeezed, and I don't think the rent's increasing quick enough to give you the higher margins, and therefore you're going to need more money in the deal, or be really savvy when you buy.
Yeah, I think again, I mean, listening to a lot of the post-budget conversations, that just the whole country, whether it be big industry, small entrepreneurs, or everybody just wants consistency so they can plan. And that's the difficulty that we have at the moment, isn't it? That, you know, again, if you're a small buy-to-let investor and you do all your sums, you do all your calculations, you set your rent, you sign up a lovely lease for 12 months and think, great, I'm on the way. The interest rate changes a quarter of the way through, you know, perhaps gone up 2 or 3 times in that first quarter. All of a sudden you're in negative territory, aren't you?
That's a really good point, and that's why that second part of the question, or the first part about planning, and I mentioned interest rates, try to get your rate agreed now, minimum 5 years. That's my opinion, because when there's fluctuation, you've got to have certainty, and then you can sort of, from a margin perspective, resolve that. The government legislation is a law to themselves at the moment, and that's a difficult thing. But you can only go, and I always say to people, whatever you're looking at, is do it based on what you know now, and that's all you can plan, because otherwise you end up doing nothing. And that's my biggest concern with property investors.
Well, of course, you know, we have this sort of buzz expression, don't we, stress testing. The banks have to stress test, a lot of businesses have to stress test, but you can create your own stress test, can't you? I mean, it's very easy to sit down and say, well, okay, this is my plan for the year, this is the rental I'm going to charge, this is what I'm paying on a mortgage, but what happens if? And you can add 2 or 3 scenarios to that and test it yourself. Do you agree with that, Bobbie?
Yeah, I agree with that, yeah. I think, yeah, you need to, banks will always stress test anyway. And when you're first getting on the buy-to-let ladder, you need to obviously realize that, is this going to be your first buy-to-let and the only buy-to-let, or are you going to then subsequently have more buy-to-lets going forward? Now, if you are, then the prudent thing maybe would be to buy under a company, maybe Zee would know better about that, but I would say, yeah, you put it in a company and let the company purchase the buy-to-let, and then you can add your portfolio within the company rather than personally buying it under your own name, because the tax implications are quite
yeah,
quite
or
high.
of course you can ring fence each one in a company again, can't you? Or a
Yeah.
series of companies, which...
A really good point from both you guys. I think I might be out of a job with the amount of advice there. That's amazing.
It's only because we've been listening to you, Zee, over the months.
The Section 24 has been huge, and
Yeah.
I think you put it in a nutshell. And that scaling,
Exactly,
and that's such a
scaling.
great point.
Exactly.
That scaling of what do you want to do, because most people don't realise when you've got limited companies, there's a cost, right? So if you're just doing one property, you're most likely not going to make money. And I've seen a lot of clients like this who say, oh, I've just got one property, but I'm saying, what's your plan over the next 3 to 5 years to purchase more?
Okay, thank you both very much, gentlemen. We're going to go to a break now. Join me again after the break when we'll be asking Bobbie and Zee more of your questions. Hello and welcome back to part 2 of Property Question Time. I'm Stephen Galpin and I'm joined by Bobbie Jethwa and Zee Razaq. Welcome back, guys. Right, Bobbie, how would the panel assess and subsequently set the rental rates for buy-to-let properties, and explain what factors they should consider? I'm guessing this is a fairly simple question in so much as I bought a property. How do I work out what I'm going to charge?
Sort of intertwines with the previous question, I think, with how you do a buy-to-let in the first place, whether to put it in a company or buy individually. If you're going to have just one buy-to-let, then I think you need to work on a maybe 6 to 8% return on your investment at the minimum. Then you're looking at the growth factor on where the property is located. Is there any? It's not only the rental, because the rental would be a set fee or set rental that you're getting, but also whether that property is going to increase in value. So then you factor that in, and that's basically part of your...
But Bobbie, if you're saying 6 to 8% return on what you've bought, I mean, I do appreciate that it seems in recent weeks the projections for interest rates going to 6% has been eased somewhat, and they're now saying it's probably 4.5% it's going to settle at. That's only leaving you 1.5% margin, even if it goes to 4.5% or stays there.
Yeah, but the banks now, I think they're quite clever themselves with the way they are giving these products.
What's new?
So yeah, exactly. So they so if you do a 5-year, like Zee was saying, like you do a 5-year deal and get it fixed, then you'll get a better rate than doing a 2-year fixed, because they know within 2 years probably the interest rates are going to fall. So they want to tie you up for longer, so you get the higher interest rate, and then if the interest rates then fall, then they make obviously more on the interest. So it sort of depends on how you go about it, and which products you've got and what sort of rates you can get. But then you have to factor that in before you obviously purchase. And then obviously putting a 25% deposit now, generally it's, on a buy-to-let, if it's a portfolio investor, then they're putting 25 to 30% of their own capital into the deal. So that's the other factor, is that putting that money in there, or now putting it into the bank and having 4% or 5% on your interest that you get from the bank. If it's a high interest account, then would you make money? So it's sort of like, because of these interest rates going up, it's kind of like making people think a bit more about whether to invest in a buy-to-let and have all the stuff that comes with it, or just simply leave your money in a bank and get the interest.
Well, I think there's two things there, Bobbie, isn't there? I mean, at one time, you assumed that if you bought property, you're going to make money. But I just don't think there is any God-given right to make money just because you buy property these days. In fact, I can point at a lot of people who've had an awfully bad time buying property and keeping it. I was interested about your comment on capital increase over a period of time. Would you actually take that into account on the rental rate that you're setting? Would you calculate something in?
I think you would have to factor that in as part of your yield for the foreseeable.
But I suppose if you're going to have a stress test, you'd go the other way too, wouldn't you?
You'd go the other way, yeah, absolutely. So then that would obviously knock it off. But I think generally speaking, the property prices, I can't see them coming down, anytime soon. I just see them maybe stabilizing and maybe going up again. But I can't see them dropping down considerably, even if the interest rates are going up. I don't know what you would say on that, Zee.
I think it depends on what type of property. So
Yeah.
if we're doing buy-to-lets, the experts, all the forecasts that I'm seeing, it's maximum, depending on location and where you're doing, 0 to 10%. If it's going to
drop?
on residential, yeah. That depends on location. Whereas commercial property, whole different ballgame.
Yeah.
So it really depends on what strategy you're doing. But I think the big thing that you mentioned there is how much money you're leaving tied in, and what's the return on investment. So you have to look at your cash flow compared to the capital appreciation, weigh that up and think, is that right for me? And also, am I protecting my money? Because the big thing we're not talking about is inflation, because that's another benefit of property investment, because prices rise and therefore you hedge against inflation. Whereas if you have the cash in the bank or you get interest, that's not clearing inflation. No. So I think that's where property is still, in my world, attractive, provided you've done your due diligence.
I think it's always attractive. It's just a question of making sure you do the right thing.
Well, and there's two other issues as well. One is I was always taught, property is not a 5-minute business. So if you think you're going in here and you're going to come out tomorrow, no, just
it's a long term. It always has been a long term investment.
And the second thing is, about these reduction in prices. I mean, I think I've gone through about 3 of these crises in the property market, but every time there's a very simple maxim: you're not going to lose money if you don't sell it, so keep it. Again, it comes back to the 5-minute rule, really. But what I've found is in each one of these dips, it's only been a dip caused by people who have been forced to sell, had to get out, had to change their property, had to change their location, and they've had to sell cheap because of that, because they've got to do it. But actually the real crisis is in the sales volume. I mean, I can remember in, I think I'm just trying to think, in the 90s, I think it was, that I can remember going for almost 2 years without seeing a sold sign. And that's the real crisis. I mean, you can create a market by dipping your price down to nothing if you want, but if the sales rates aren't there, then you have got a problem. But no,
and you've got the early repayment to factor in. So if you were to sell and say people are trying to lock themselves into a longer term product, and they're saying, well, okay, let's lock ourselves in for 5 years, 10 years even, so at this rate, and then say circumstances change, you want to sell, then you've got the issue of, okay, now the bank want 7-8% early repayment. So you have to factor that into your sell cost, and that's another issue in itself. So then when you're trying to do the investment, you're trying to make the money, but then you're giving all your returns back again to the bank.
Do you know what? I think the moral here is something that we go over and over again on Property Question Time. Get your team around you. You need your accountant. You need your good agent. You need all the good advice you can, because there are so many factors affecting your investment, aren't there? Anyway, let's move on. And Zee, I'm about to enter the world of property investment with the creation of a buy-to-let portfolio. What accounting and portfolio structure advice would the panel give? Now, we touched on this earlier with, do we use a limited company? Do we use a group structure? Do we, come on then.
Well, I've got like 3 tips on this, right? First of all, if you're doing an investment company, this is what it will be, buy-to-let. Make sure it's a family investment company. If you're doing legacy planning, do that at the beginning if you can. Number 2, have a group structure, because people these days, especially now, have buy-to-lets, but they also venture into service accommodation, furnished holiday lets. You've got to split it because of VAT. I know people don't like VAT, but VAT can be your friend if you know what you're doing. And number 3, which is quite important, is combine it with a SaaS pension. And we've done a whole video on this, and especially with things that are coming into the public light now, where there's new incentives. If you combine those 3 things, those are my tips when you're thinking about a buy-to-let portfolio.
So if you are, let's say, the smaller investor, I mean, just off at the top of my head, I mean, you're an accountant, you know these figures, but I'm thinking, from my experience, even if you have a fairly simple limited company, and I mean simple by, you know, minimal transactions, perhaps a monthly rent going in and 1 or 2 expenses, things like that, it's still going to cost you 2,000 or 3,000 a year to run, isn't it?
Potentially, depends on.
Yeah, you know, I'm sorry, I'm not trying to pin you down on accountants' fees, but I mean, just as a broad brush sort of figure, it's not going to be far away from that up or down.
It depends on what kind of service. And this is where, when you get into pricing without quoting, and this is where I always say to people, it's like, how long is a piece of string? Because if you are going to be very active and what you're going to do and what kind of service you need, and that's how a lot of very good accounts, especially if you're doing property, you're paying for specialism and you're paying for the type of service. How many times you're going to meet your accountant. So this is why you can't do a broad brush price on it, because that's why you should have a quote done on your requirements. So I think that's really important. But I think the bigger question is, how many properties are you going to have in your portfolio? And that's the question that really drives it, because it's not the cost of the accountant, which people think about, it's profitability. Is it going to be profitable? And it depends on what type of rent roll you're getting and how many properties you're getting, and therefore the margin. And I think that's the bit you should be focused on, because I always talk about value rather than cost. And we get into this bad habit of talking about cost without thinking about value. You need to think about value then cost is in relation to that value. And that's the way you should be thinking.
I think the point that I was making is that, you know, don't think it's just, I'll have the company and that's just a bit of paper and a share certificate. There is a calculable cost, whether you have it by quotation or whichever method you use. But it is a serious consideration, isn't it, in your profitability over these things. And the lower the number of properties you got, the higher percentage of your profit it's going to take, actually. So.
Yeah, it depends on what you're doing with the properties as well. And it's a bit hard to even say number of properties, because if you're doing HMOs or you're in higher margin areas where you're having higher margin and the refinancing and then pulling money out, there's so many variables. But generally, if you are going to scale the business, especially buy to lets, on average, especially with all the tax changes, limited company has become more attractive for that. Not always. And that's why you need that consultation, get a strategic view, and then make decisions.
100% agree. Okay, gentlemen, thank you both very much indeed. That's Bobbie Jethwa, CEO of UK Property Agents, and Zee Razaq, CEO of Surtax and Tolbans, property and industry tax experts. Well done. Thank you very much for your answers. Thank you for watching. I'm Stephen Galpin. I'll see you next time on Property Question Time.